So welcome everybody. My name is Pieter Kleppe. I'm the editor of Brussels Report, and we're very happy to host this debate here together with MEP Johan van Overveld in the European Parliament, and of course together with the Cobden Center, Alumni Students for Liberty, Tolos Foundation. So monetary policy has been, let's say, a very intense debate, I would say, very much since 2008, the financial crisis. But many people have been harshly criticizing central banks since then for how they have dealt with the fallout and the problems. Despite that, we haven't seen the warnings of inflation materialize. I would say only until 2001 sometime. And then we saw really high inflation, partially triggered, of course, by energy inflation. And both in the United States, other places, specifically also the Eurozone, we have then had central banks taking action and increasing interest rate. So we're here to discuss that, to look at how central banks have acted, to check, to what extent they are responsible for the inflation, to check to what extent that they are, doing their job right now in a good way to try to fight inflation, and some side issues as well. And we have a great panel, of course. MEP Johan van Overveld, who's the former finance minister of Belgium. He's also the chairman here of the budget committee in the EP. We have Barbara Kolm, the deputy president of the Austrian Central Bank, and also a well-known, I would say, one of the most well-known proponents of Austrian economics, as the president of the Austrian Economics Center in Vienna. We have Jorge from Alumni Students for Liberty. Is from Venezuela, an economist. So it will be very interesting to hear what happens when things go really wrong when it comes to money. And then we have Max Rangley from the British Cobden Center, who's also a great expert in monetary policy and in favor of honest money. So that said, let me give the word to Johan van Overveld.
Thank you. If I am correct, we each have 10-12 minutes.
10 to 15 minutes, and then we'll have a Q&A.
If we discuss monetary policy today, of course, we do it in one breath with the inflation problem, because the two have been like Siamese twins in the policy discussion. I'd like to make 4 points. First of all, and that's all, of course, to some extent already old stuff, we've come late to the class, so to say. We were late, or central bankers were late to recognize that there was a problem. And of course, that is easily said today, but I can claim here and refer to my blog that already at the end of 21, I was arguing that gentlemen and gentle ladies, wake up. This is serious. This is not something that will pass by just like that. And it had initially nothing to do with Putin gas prices or the invasion of Ukraine. Why did it take so long in terms of months for the central banks to wake up? I think the basic thing was a kind of complacency, where central banks more and more took for granted that what they said about inflation was what automatically would follow. And that if they kept repeating that they would act if inflation would really in a significant way deviate from 2%, that they would intervene. And that has, of course, worked as a boomerang for the central bankers. My second point is related to the fact that I count myself among the people who had the fortune of being able to speak twice with the late Paul Volcker during my life, the chairman of the Federal Reserve from 79 to 86, the man who conquered almost single-handedly the 70s inflation. And the last time I met him was during the period I was Minister of Finance in 2016 at the annual meeting of the MFF, where he told me inflation will come back. Sooner or later it comes back, or it always comes back. And don't forget, my dear friend, if you want to conquer inflation, you never can conquer inflation without real interest rates. that means inflation rates at least as high as interest rates at least as high as the inflation rate. If you don't do that, forget it. You will never conquer inflation. You will have ups and downs, but you will have the problem on your plate. So that's something I think we should take into account today. We can, if you look at core inflation, we can say that the Federal Reserve is more or less there, more or less, still a little bit to go, but the ECB is of course far away from getting to real interest rates. The conclusion of this point is of course that if they don't do the increase in interest rates up to the level of inflation, that they are not serious about fighting inflation, which is of course an option they can take. But we should be well aware of what the consequences are. You cannot say that you want to fight inflation in the present context and leave real interest rates at negative levels. That's a contradictio in terminis, as they say in Latin. Third point I want to make, it is of course not only monetary policy. It is also fiscal policy. And I'm not a very big fan of the fiscal theory of inflation. John Cochrane and other people who have written unreadable books about that. But the fact of the matter is that if you push the brake on monetary policy to control inflation, whereas the political authorities push on the gas in terms of fiscal policy, then you won't be able to control inflation. No, let me correct that last statement. You can control inflation, but at a huge cost for your economy. So there needs to be a kind of harmony between fiscal and monetary policy. And at the end of the day, also under this third point, these are the things that matter for inflation. I find the whole argument about greedflation is ridiculous. That's the only word I have for it. 2 points with respect to greedflation, companies beefing up their profit margins and so fueling inflation. These data are about EBITDA, earnings before interest, taxes, and depreciation. Interest. So if you look at the interest that companies have to pay in 21 or what they had to pay in 22, that's a huge difference due to the rise in interest rates that arrived during 22. So you're talking nonsense if you only look at EBITDA and then say, you see, the profit margins are increasing because you take the interest out. Secondly, I can very well understand CEOs of companies during the whole of 22 that they were very uncertain about the seriousness of the central banks to fight inflation, so that they anticipated inflation. I would even go a step further. They would not have done their job if they did not have anticipated higher inflation. And now come back and say, like the ECB has been doing, a terrible mistake, it is the companies beefing up. Madame Lagarde said it here earlier this week in the Econ committee. That's a huge mistake. That's a blunder that no central banker should allow himself to make. Fourth element, I think we need to be we need to throw out the window very carefully and very well thought through the inflation targeting 2% idea. I think it's nonsense. It has not served us well, because by trying to get to 2%, even if inflation was at 1.2 or 1.4, we've been doing the most extraordinary things, quantitative easing to the limit. That has not helped us, that has created bubbles, that has created all kinds of distortions that have not helped us. And I want to cite from a little book I wrote last year on what the same Paul Volcker thought about inflation targeting. And this is from his memoirs, who were published in 2000.
So maybe to explain, so inflation targeting is that you do not only try to keep inflation under 2%, but if it's like 1%, you say, oh, it should be 2%.
You start pumping up money when you're, according to your opinion, too far away from 2%, which in practice meant that even 1.4% was too far away from 2%. But Volcker said the following, and I quote him literally: I puzzle about this rationale of 2%. I know of no theoretical justification, but I do know some practical facts. No price index can capture down to 0.1% the real change in consumer prices. The variety of goods and services, the shifts in demand, the subtle changes in prices and quality are too complex to calculate precisely, month to month or year to year. Concerns are being voiced that consumer prices are going too slowly just because they're a quarter or so below 2%. Could that be a signal to ease monetary policy or at least to delay restraint even with the economy at full employment? Certainly that would be absolute nonsense. That's Paul Volcker in 2018, and I think it's still very relevant today, so let's get rid of it. And let's take as a guidepost another man who maybe is less fortunate in terms of his historical agency, Alan Greenspan, who defined price stability, because then if you throw out inflation targeting 2%, what then is price stability? And he defined it as that state in which expected changes in the general price level do not alter business or households' decisions. That means it can be 1%, it can be 3%, it can be -2%, but the moment you see that businesses and households, individuals, do not factor in explicitly expected inflation, because that's what's important, expected inflation, then you have price stability. I think we need to look at that, and we have to stop looking at only the consumer price index. We have to get back to the good old monetary aggregates and credit aggregates to have a balanced view of where monetary policy is going, given the state of the economy. Thank you.
Thank you very much. Then we will now move to the second speaker, Barbara Kolm, Deputy Governor of the Austrian Central Bank. Maybe if you can hand the micro, I think we only have.
Thank you very much. Thank you for the kind invitation. And first, I have to make a disclaimer. I'm not speaking on behalf of the central bank. I'm speaking as Barbara Kolm, as a private individual who runs the Austrian Economic Center and the Hayek Institute. So from this background, you may see where I come from. And this is also why I would like to pick up on two things. First of all, monetary policy and fiscal policy, which was already mentioned. And or actually, those two things should have been kept separate and independent. And I just say should have been kept. Until now, we have the situation that we are in, where we can solve the problem right now only if we have a close communication and a close collaboration between fiscal policy and monetary policy. This is one thing. The second thing, I would like to also go to or throw out the term of equilibrium interest rate, or R star, that nobody has actually looked at for a long time. And this is truly important if we want to fight inflation and if we want to go back to normalization of monetary policy, because these days, to be straightforward, we don't have a normal monetary policy as we knew it before 2008, or actually even further then. Because if you just keep in mind how was the secular decline of the interest rate, it started out very, very high, and then in the 70s it was already touched on, and we kind of maneuvered about 8%. Then with the dot-com bubble, we went down again after the dot-com bubble and the burst of the sovereign debt crisis, or put it this way, the sovereign debt crisis came to Europe because of Fannie Mae and Freddie Mac, the GFC. We went down to 3%, from 3% further down to now gradually 0 and below. And so, what would be the R star in Europe these days? Definitely below 0. We need to rise it again, because what is interest? Price for money. People keep forgetting that. This is basic principles. So what are the explanations for the decline of the real rates? And they include the slowdown of productivity and productivity growth. And this is especially true for Europe. And since we are here in this building, it should be addressed as well. How can we create growth again in our economies? Then the shifts in demographics, also a truly European problem these days. And then, of course, global factors affecting the real interest rate, premium on safe and liquid assets or lower economic growth, etc. Having said that, I would also like to say that we actually have seen the first sparks of inflation already after the Green Deal had been announced in 2018. And the Austrian Central Bank has made calculations that around 0.5% average was due to the Green Deal, because, and this is a very logic thing, this is a great program. It's truly important, but nobody has priced in and factored in the time gap for the industry to make their adaptations, to get their innovations in place. And as soon as you have these problems around, energy prices start rising. It's supply and demand. So how does actually, from an economic perspective, from a school book, Austrian economics, Hayek, business cycle theory, and other things, come inflation about? Of course, QE, expansion that we have seen ever since the European Stability Mechanism, as actually the start of the APP programs, the asset purchasing programs in 2014. And then we did an extra add-on with the COVID programs, with the PEP programs. So we actually built more than 3 trillion from 2014, actually beginning of 2015 onwards, and it did added another 1.7 within the 2 years of COVID. So the expansion is one thing of the monetary base. The second thing, which triggers inflation, was directly the lockdowns, because if supply and demand cannot be met, the supply chains are broken up, prices are being distorted. Next thing that triggers inflation. And lastly, of course, that was already mentioned, was the last kind of oil into the fire was the war of the aggression of Russia to Ukraine. So those three things actually create a shock per se. And if you add up all those together, then you see the rise of inflation as we do these days. So what is the roadmap? How can we get back to normalization of monetary policy and get rid of this unconventional monetary policy that we have seen? So one thing would be, of course, the rise of our star, which is interest rate. But then there is other things, that is non-standard tools that we should look into, that allow the central bank's policy space that is constrained by the zero lower bound to get back to the rise. We would also look into other tools like the stop of the APP programs has already been in place. We reduce the balance sheet by 15 billion per month in average. However, looking at the balance sheet of the European Central Bank and, of course, our national central banks, it will take a long time if we do it at this rate. So having said that, and this I have to stress it, you already mentioned it was too late and too little with regards to the rise of the interest rate. As an Austrian economist, I would say we should have done it latest in 2016 when the growth rates had kicked in. So this would have been a perfect opportunity to start rising interest rates back then. But obviously this did not happen because of policies to save certain countries in the south. Another thing that we should look into was communications. And this was since you mentioned Paul Volcker, in the 70s, the communication was totally different than it was than it is now. And back then, the so-called forward guidance was straightforward, and it was expected, was explanatory, And now it is over the past years, it was just kind of meandering through and not straight. So this is something that one could also or needs to change as well. By the way, the Bank of Japan has also finally dropped forward guidance after 30 years or so almost. And then, of course, the targeted long-term refinancing operations, the TLTROs, need to be looked at very closely. Let me see. There are, of course, if you look at this unconventional monetary policy, there are positive sides with it. And there are negative sides. And negative sides I already mentioned before. This was the zero negative policy interest rates. It was the forward guidance. It was the QE programs, and it was the loan subsidies, the TLTRO. The positive sides, if you want to look at this, it was the provision of additional liquidity with very interesting conditions for banks, which actually refinanced them or actually changed their business operations and models during these past 15, 20 years almost. Now there's a joke going among the bankers. The young people in the industry need to learn and to operate again under the scheme of interest rates, because this is what many of them had not been working with and had not studied and do not know the business model of a classic retail bank. So they will have to start completely rethinking and redoing their business models. And then on the last sentence, I would just simply say CBDCs will not be a solution to the current problem of inflation. We can only target inflation with reducing, as I mentioned, the sheets, rising the interest rates, and finding a balance. Of course, there will be issues with many so-called zombie companies that have been able to survive for a very long time due to the cheap and easy loans. But I think this is something that we need to address on another page. But maybe I would keep it as for now for the first round. Thank you.
Thank you very much, Barbara. Then now we go to Jorge Jraissati, if I pronounce that well, the director of Alumni Students for Liberty. Students for Liberty is an international federation of free market-minded student groups, great people. And as I mentioned, Jorge, you're originally from Venezuela, which is, of course, a country that sadly has experienced a lot of upheaval when it comes to monetary stability. So please.
Thank you, Peter. Thank you. And I want to thank you and everybody who is in this panel, because exactly, coming from Venezuela, we know the effects that, for example, these kind of processes can turn. So what I will speak about is the political effects of these kind of processes. Coming from a country like Venezuela, we don't have the luxury to debate monetary policy. We don't have the luxury that Europeans have, which is to have institutions where you can have dialogue, debate, where people have a shared interest to pursue the common good. On the contrary, in countries like mine, what we have is political and economic institutions who are basically to the service of kleptocrats, oligarchs, people who are using the state to pursue their own interests, people who are using the state to enrich themselves, even at the expense of putting millions of people to hunger, to misery, and to forced exile. And it is important that I begin highlighting this fact, because inflation and economic mismanagement is not just an economic problem, it's a political problem. If Europe wants to preserve the democratic and peaceful institutions that you have, you need to have an economy that creates prosperity and opportunities for the people. What I believe is that there is a two-way relationship between political instability and economic performance. Because what is the problem with countries like mine is that you have democratic governments who incurring mismanagement. You have democratic governments who create economic problems. And that leads to populist and demagogue processes. people lose faith on the system. People lose faith of being represented by the political and economic institutions. So that leads to these processes such as the process of Hugo Chavez. Hugo Chavez was elected in 1998 in Venezuela under democratic rule, but then he became a dictatorship. And one of the ways he did it was through controlling the central bank and through imposing monetary policies that were financing his massive and crazy plans. So then what happens is that democracy becomes dismantled, becomes to deteriorate, problems begin to rise, and then you have politicians blaming corporate greed. You have politicians blaming business people for problems that they create. So the first thing that I want to say is that what we need to do is to counteract this narrative, the narrative that business people are the ones who create inflation in our countries. And this vicious cycle that is created when these countries go through this road is then very difficult to stop. So we need to stop them before they go too far. I would say that first, the issue of inflation has to also be seen from a moral perspective as well. We not only need to discuss the economic effects of having a country with high inflation rate, the inefficiency that this brings to the table, but also the morality aspects. We need people, the dignity of people is in their hard labor, is in their savings, is in their salaries. And we need to protect these things. And we need institutions that protect these things. So first, I will try to give just 3 points, three recommendations to try to strengthen the European economy. And again, not only taking into consideration the performance and the efficiency of the single market, but also trying to enhance the political instability and the geopolitical position of the European Union as a whole. The first one is I will try to re-emphasize what Johan said before, is that we need monetary measures to improve the inflation rate. We need the ECB to continue its process of monetary tightening, aim at mitigating all the problems of low interest rates for so many years. And also, we need to continue the discontinuing of its assets purchasing program. But at the same time, this monster cannot be controlled if you don't have fiscal measures in the long term. Because the problem in all these processes is that the monetary policy is created to try to overcome the fiscal problems that all these countries have. So what we need to do in Europe is to then create some kind of fiscal tightening to these countries, because otherwise there will not be a solution. Where should inflation be? I think 2% maximum is the thing that what the empirics of economics says. And the second policy recommendation that I have is that from abroad, what I see is that it is incompatible to try to battle inflation and at the same time use the next generation European funds to incentivize short-term consumption. To me, it doesn't make any sense, because if you have these funds and these loans to incentivize short-term consumption and not use this fund to improve the structural aspects of the economy in the long run, then you are not really committed to battle inflation. What you are committed is to provide even more fiscal support to these kind of countries. And we already know that the external factors are going through. The energy crisis is fading away. So all these fiscal supports that countries have to mitigate these exogenous factors, they need to stop, because otherwise you will not be able to control inflation. As Barbara said, we need growth. In Europe specifically, we need productivity growth. For so many years and so many decades, growth, total factor productivity has been almost stagnant. So what we need to do, what I encourage people to do, is that we need to push for a different kind of notion of inequality. People used to see inequality from a consumption perspective. They say to see public policies as ways to address or to mitigate the differences in consumption between different sectors of society. This is a wrong way to see the issue. Inequality is indeed an issue, but what we need to do is to try to mitigate or to shorten the gap of inequality of productivity, of economic inclusion. And the way to do this is to create the infrastructure and the policies so that everybody joins the productive flow. We need to create the policies so that everybody has access to good jobs, quality jobs, with good infrastructure, with good public goods. And this is really the way to have a long-term viable European economy. The problem with places like mine is that you start subsidizing more and more the liabilities, and you start subsidizing more and more the consumption of people to the detriment of the productive flow and the productive economy. And when that happens and this process continues, then we know what are the results of that. So for the next gen loans and infrastructure, what I would hope the European Union would do is to incentivize this structural transformation that Europe needs, because Europe definitely needs a transformation. Like coming from abroad, what I see is that you have all this capacity, you have all this potential, but the policies are in there stopping the people and stopping entrepreneurs with all the regulations and all the difficulties that they face. And the third element that I would like to emphasize is that we are living also in a new paradigm in terms of geopolitics. We saw it with Russia last year, but we also see this with China. And I think that this new economy that we're trying to build, this new economy that we're trying to design then in Europe, it also has to have an element of resilience. And how can we build this resilience? I do believe that, for example, the European Union has to find ways to mitigate the leverage that China has in the region. China likes to blackmail, likes to coerce countries for their political ideas. So we need to find ways that we all, at the European Union and abroad, that we join. 2 weeks ago, I was speaking in something called the Copenhagen Democracy Summit. And there I heard an interesting proposal, something called the Economic Article 5, which is similar to the NATO Article 5, but for economic matters, which basically means that we, democracies, we should find ways to protect each other from external attacks in the economic realm, which is something that China does on a consistent basis. China has done it with Australia, with the European Union, and with other partners. So something that I will encourage is the European Union to keep strengthening this. I have talked to people close to the European Commission that have mentioned me something called the anti-coercion instrument. I believe in that. I believe in this kind of geoeconomic tools that we can use to mitigate the problem that we have with China. And similarly, of course, continue decoupling with the Russian economy, continue decoupling with the Venezuelan economy, because I really believe that last year was a wake-up call that authoritarians are on the march, a wake-up call that dictators are emboldened, that they are forceful, and that they believe that they can win this battle between democracies and autocracies. An essential element to win this battle is us to have a strong economy, a united economy, an economy that provides jobs and opportunities to people. Because something that I see when I come to Europe is that many young people feel forgotten by the system. They don't have hope for the future. They see the state or Brussels too far away from them. And what we need to show them is that democracy and the European project is the best project that they can have. Because for me, from somebody who comes from Latin America, this is a beautiful project in which people can unite, in which cultures can become more interdependent, in which you have a single market, you don't have tariff, and you have created a space of collaboration where all of you in Europe have a single agenda. So we need to protect them. And one way to do it, honestly, is to rethink the way we see our economies. We don't want inflation. We don't want a state that subsidizes consumption to the point that it destroys the economy. And what we want is to find a ways that Europe is productive again, grows again. And that's why this panel is so important, because ultimately economy can change the lives of millions of people. When people, for example, leave hyperinflation, people left hyperinflation in my country in the millions, then their lives are completely destroyed. Their savings are destroyed, their salaries are destroyed, and that's not fair. That's not a just system. And the things that we are all, we are all advocating here is a system in which people can enjoy the benefits of their work and can live a.
Thank you very much, Jorge. And actually, it reminds me, if you look at the situation in Turkey now, Turkey, which is sort of between the two worlds, definitely partly in the authoritarian part of the world, you can see how monetary policy is crucial there. Erdogan is trying to appoint Volcker-style figures at the central bank, at the Ministry of Finance, and so far the markets do not seem convinced. The Turkish currency continues to crash, but it's a good indication of how important monetary policy and solid money is to sort of stay on the right side of the authoritarian versus liberal divide, I would say. So that said, let's go to last but not least Max Rendley of the Cobden Center.
Thank you very much, Peter, and thank you for inviting me today. And this event really couldn't come at a more important time, just as more and more people are at least beginning to understand some of the implications of monetary policy of the last few years. But it's important to understand that actually inflation is really just the tip of the iceberg in terms of the consequences of central bank policies. Over the last few months, we've seen a series of bank failures in the US, and last year we saw the near blowing up of parts of the British pension system as a result of so-called liability-driven investments. And this caught a lot of policymakers by surprise. Yet in actual fact, most of this was very predictable. So I actually gave a series of speeches here in the European Parliament through 2018 and 2019, and actually even some years before that, talking through some of the consequences of 0% interest rates. In particular, the extraordinary distortions that were being caused to the economy and the historically unprecedented buildup of risk in the economy as well as a result of these policies. But it's also important to understand that this huge buildup of risk and debt has not just taken place just in the last few years, but actually over the last generation or so, really from the 1980s onwards, what we've seen is central banks responding to each recession by creating a series of larger and larger debt bubbles, by setting interest rates lower and lower. So this current roughly $300 trillion global debt bubble that we're in, which is just beginning to unwind, is not something which just built up during COVID or even during 0% interest rates. This has been inflated over the course of 40 years, which is something quite historically unprecedented. So today I'm going to talk through a couple of issues that relate to this. First of all, I'm going to briefly outline the current monetary system, and in particular, how money is created in a modern economy. And then I'm going to touch on a couple of key economic thinkers, which help us understand the predicament in which we now find ourselves. So first off, then, the current monetary system. How is money created in a modern economy? And this is crucial to understand. So the vast majority of economics textbooks, in fact, almost all of them, teach something along the lines of the following. What a bank does is it takes money from a saver, it leaves some in reserves, and it then lends out the rest of it to borrowers. So, for example, Joe walks into a bank, he deposits $10,000, and the bank, for sake of argument, leaves 10% of that in reserves and lends out the other $9,000. And it may, for instance, charge 6% interest on those loans and pay 3% interest to Joe, so-called fractional reserve banking. So that's what's taught in almost all economics textbooks. Yet this is, in fact, entirely false. In reality, in a modern economy, when a bank makes a loan, it creates that new money out of thin air. So if you go into a bank and you want a mortgage to buy a house of, let's say, £500,000, the bank does not go into its reserves and find a pool of savings of £500,000 and lend it to you. It simply creates that £500,000 out of nothing. Now, you may well find this quite extraordinary. And in fact, I've explained this to a number of people over the years, and I've even had some very senior people in banking and even central banking that have been quite incredulous. So I interviewed some people right at the top of this system over the last few years, including William White, who was the chief economist at the Bank for International Settlements, that is the central bank of central banks, based in Basel, responsible for the Basel regulations, which you may well have heard of, and also Lord Adair Turner, who was the chief financial regulator in the UK, and has also actually worked with the Bank for International Settlements in Basel as well. And indeed, they both confirmed in these interviews, which are published, that banks do not lend out savers money. When a bank makes a loan, it simply creates that new money out of thin air right there on the spot. But you may well be thinking then, are there some ethical considerations with this system? And indeed there are. So if we return to our previous example then, if you want to buy a house and you go into the bank to borrow £500,000, the bank then creates that money on the spot. £500,000 of new money is created into the economy. And you then proceed to spend the next 30 or 40 or 50 years paying interest on this money, and of course paying down the principal. And in fact, now we're seeing the first multi-generational mortgages being given. But then, of course, additionally, if you happen to get into financial difficulties, if you lose your job, for instance, and you're unable to make your mortgage payments, the bank will then take your house from you and it will sell it in order to pay off that mortgage. So you, in essence, will be living your life as a debt slave based on money that was simply created out of nothing by the bank at that moment in time. But there's also one other point relating to how money is created, and that's the macroeconomic aspect. So just as new money is created when a bank makes a loan, when people pay off debt or when they default on their debt, that money is actually destroyed. It simply ceases to exist in the economy. So what we see is during boom times, when assets are going up in value, we see a lot of money created by banks in the form of loans. But then when the credit crunch hits, assets fall in value, people default on their loans, that money is actually destroyed. So this is what we call a pro-cyclical monetary system. It gets into feedback loops, both during the boom and then also during the bust. And that then brings me on to the next part of my talk today, then, which is looking at a couple of key economic thinkers who are relevant for understanding the consequences of this. And the first is Richard Cantillon, who was an 18th century French economist. And the second is Friedrich von Hayek, who was a 20th century Austrian economist. But today we'll actually start with Hayek. And one of his key ideas was that interest rates are a critical pricing mechanism for the economy. So in many respects, similar to the price of food or fuel or consumer goods. And if we think about when governments, for instance, set the price of food artificially low, for instance, in Venezuela, we know what the consequences are. There are food shortages and in many cases, starvation. So really, we should not be surprised that when central banks set interest rates artificially low, what we end up with is these huge debt bubbles, but also other far more subtle forms of distortion to the economy. But as I mentioned in my intro, this is not something that's just happened over the last 5 or 10 years. Really, from the 1980s onwards, central banks across the developed world have responded to each recession by setting interest rates lower and lower, thereby generating larger and larger debt bubbles. So if we think about America, for instance, when the bubbles of the 1980s burst, in property and some other sectors in the late 80s, the response from Alan Greenspan in the early 90s was to set interest rates at 3%, the lowest interest rates for generations. And then following that, there were several years of the Greenspan put. And that all served to create an even larger bubble than that of the 80s. That was the dot-com bubble. And then when that burst in 2000, the response was even lower interest rates of 1%, which then created an even larger bubble, the housing bubble. And then, of course, when that burst in 2008, the response has been the lowest interest rates in history, years after years of 0% interest rates. And that, in fact, has created a far larger bubble than that which existed in 2008. So in 2007 and 8, the total global aggregate debt, that is household debt plus corporate debt plus government debt, was around $150 trillion. That was already by some margin the largest debt bubble in history, both in absolute terms and relative to GDP. But after years of 0% interest rates, that reached around $300 trillion of global aggregate debt. So in fact, far from bringing about a return to prosperity, what central bank policies like 0% interest rates have done is served to essentially double the size of the global debt bubble since 2008. Now that then brings me on to the second thinker I mentioned, which is Richard Cantillon. And Cantillon was writing in 18th century France, and his key idea, which is important for us today, is actually known as the eponymous Cantillon effect. And that is the idea that when new money is created, the recipients of that new money benefit disproportionately. So in the days of Cantillon, this was the French royal court, those around the king. So they would receive newly created money, and they could then spend that money on goods, or they could invest it in assets. And then over time, that money would circulate around the economy. And the prices of goods would go up, and the value of assets would go up. And of course, the people who receive this newly created money last, i.e. the peasants, will have to suffer the consequences of those rising prices. But if we think about a modern economy in the 21st century, then, it's not so much those around the French royal court. The people who benefit from money creation, it tends to be large corporations, large financial institutions, and also speculative financial institutions, such as hedge funds. A hedge fund, for instance, if it needs to borrow money at 8 or 9% interest rates, it can only leverage up so much. And in fact, the majority of funds would not be really profitable if that was the case. But if they can borrow money at 0% interest rates, they can leverage up massively, and they're effectively artificially profitable. They're benefiting from this new money creation. And what they will also tend to do then is pull in resources from the rest of the economy. So we've all heard of physicists and mathematicians and engineers going to work for hedge funds and other speculative financial institutions rather than doing something productive and inventing things. And that's because those types of institutions have benefited from this system of money creation over the last few years, but to a certain extent over the last generation. And so to conclude then today, there's really three key points that I've touched on, which I think are important to understand if you want to get to grips with what's happening now and, in my view, what's going to happen in the coming years as things get much worse. And that is, first of all, the system of money creation. So the economics textbooks actually have it wrong. Banks do not lend out savers money. They, in fact, create new money when they make loans. And again, you can see the published interviews I've done with people at the BIS and elsewhere on this. Second of all was the idea from Friedrich von Hayek that interest rates are a core central pricing mechanism for the economy, just as important as the price of food or anything else. So what we've seen over the last generation of central banks setting lower and lower interest rates over the last 40 years, that's what has served to create the predicament that we're now in, which is an approximately $300 trillion global debt bubble. And then the third point I touched on was Richard Cantillon, and in particular his idea that when new money is created, the beneficiaries of this system are the people who receive that money first. So whereas over the last few years, many people's living standards have been essentially stagnant, some people have actually done very well over the last few years out of this system. And if you look a little bit more carefully, what you will generally find is that those people who did very well over the last few years are those people who were on the receiving end of the newly created money, the huge amounts of newly created money over the last few years. So thank you very much, everybody.
Thank you, Max, for providing some insight on how a lot of the problems that we witness have deep roots into our monetary system. Actually, before I go to the floor, I would like to go into one small thing of your story. Something I think that you did not perhaps sufficiently mention is that the current system is not merely designed, I would say, to benefit those close to central banks. But obviously, at the end of the day, the whole point is to finance government spending, or at least to make sure that that part of government spending that cannot be financed with taxation is financed through expanding the monetary mass by and of course with the goal to suppress the price of money, the interest rate. So when government take out a loan to pay back the old loan, I mean that's standard government practice, that they don't have to, that they don't have to pay high interest rates. With the side effect ultimately being what you mentioned, that those sort of inside the financial system, specifically hedge funds, but of course also anybody with a banking license would benefit. So would you agree that sort of the intention is maybe not bad, is to try to keep government financing going with unintended side effects, rather than that it was meant to benefit those close to the central banks?
That's an interesting point, Peter. So certainly governments benefit from this system. Huge government bonds have been purchased. And yes, so the system has not been set up deliberately to benefit these providers. In fact, there's many people within central banks that are now looking seriously at how to reform it, including actually William White, who I mentioned, who was at the BIS. But nevertheless, it is in general will reserve, because they do certainly benefit from it.
Right, good. Maybe unless somebody else wants to make an intervention related to the last point, we can maybe go to the floor. Oh yes, Barbara.
I mean, there was a good reason why we had the Maastricht criteria and other rules in play. And if we break our own rules, what do you expect then? And again, I think the division back then should have totally been made between monetary policy and fiscal policy, which actually did not happen. Now we have to make sure that fiscal policy and monetary policy goes hand in hand in order not to overspend and make the same mistakes that we did during the COVID crisis.
Okay, you wanted to chip in, or?
Yeah, sure. What I can say is that this is all about fiscal policy. Like, that's correct, because monetary policy in itself follows politics. And I think that's the dangers of it, is that we say that we have central banks who are independent and who are autonomous and all that. And all that is great in theory. However, what really ends up happening is that the central bank needs to follow what the fiscal policy is trying to do. So in Latin America, we always have these hyperinflationary processes because of the fiscal deficits from the central government. This process is exacerbated in countries like mine, where our source of revenue or fiscal revenue is so volatile, because in my country it's from oil revenues. So if you can see, when oil started to decline in 2014 and 2015, then our deficits, our budget deficits began to grow and grow. And the only way is to monetize the debt through monetary policy. So the central bankers are forced to do so, and it becomes a vicious cycle, because then the value of your currency goes down, your productive capacity also is affected by that. So in terms of the European Union, coming back to the topic, is that the only way that we can assure that we have financial and monetary stability in the long run is with a fiscal responsibility from the governments. It is not a surprise that I think most people in this panel will agree that the current levels of debt, of government debt, and of deficits is unsustainable. And the reality is that because of COVID, many of these policies were masked and were sold to the population as ways to mitigate the deficits or mitigate the external shock of COVID. But the reality is that all these were stimulus programs. If you see the size of the stimulus programs in the US was roughly 3 times the size of the downturn because of COVID. So these were not really measures to counteract COVID. It was really a Keynesian program approach. It was a Keynesian approach for stimulus. And this is something that we cannot agree. And the problem, what is the problem? The problem is that if you keep these fiscal levels and you keep raising interest rates, then really the only solution is to raise interest rates so much that then you have also financial constraints. You have some financial distress. And this is something that also worries me as well. I saw the speech from Lagarde a couple of days ago in which she mentioned that she doesn't see any trade-off between monetary stability and financial stability. However, if you don't control the fiscal levels at the medium term, then the amount of pressure that you will put on banks is simply unsustainable. And we are seeing this in the last weeks, Credit Suisse, the Silicon Valley Bank. So I really believe that, yes, there is no trade-off, fiscal, financial stability and monetary stability, as long as you have the fiscal stability in check.
Maybe, Johan, also what I wanted to add, and specifically for you, I mean, as a finance minister, you had experience. You served as finance minister during times when Greece was at the verge of leaving the Eurozone. It's clear that apart from financing runaway government spending that cannot be covered by taxation income, specifically in the Eurozone, a lot of these programs are, of course, meant to keep the whole monetary union together, right?
Well, as a matter of fact, the ECB has become the ultimate guarantor of the further existence of the euro. It's quite it's as simple as that. And one of the things that we need to look out for in the coming period is if the ECB does what Lagarde and others have been saying recently, that we will see at least two more interest rate increases, probably 25 basis points. But anyway, we will inevitably, if they continue on that road until we have real interest rates, positive real interest rates, then you can bet on it that we will see the spread, which is the difference in the interest rates on, for example, German bonds and Italian bonds or Greek bonds, will start to increase, which will create a huge political, well, it will first create a financial problem, and then the day after it will create a huge political problem, because obviously the pressure will then be on to do what. But you can hear me? Okay, continue like that because the mic is back now. Okay. To make sure that these Italian, I don't want specifically to point to Italy, as a matter of fact, I could also point to Belgium, to bring these interest rates down. Now, there is no magic to that, and they've been inventive with programs that the transmission of monetary policy throughout the European, throughout the Eurozone, that's of course bullshit. What they want to do at that point in time is to bring down Italian interest rates, which can only be done by buying Italian bonds on the market. But not in principle, the ECB cannot do that. If the ECB intervenes on the bond market, it has certain rules to follow, that it can not only buy Italian bonds, but it also needs to buy German bonds and Dutch bonds and Austrian bonds and the whole thing. It cannot only buy Italian bonds, which is, at the end of the day, the only solution to an increase in spreads on Italian bonds. And we'll see what happens then. We see what happens then if the Germans and the Dutch and probably also the Austrians see this happening, whether they will say, Madame Lagarde, you will have to stop doing this, because that's the end of the euro. By the way, that's a book I wrote 10 years ago. Because it will be unbearable for Italy, because their interests burden on their huge debt will explode. They will have to default on their debt. And there's one thing that nobody ever speaks about that I want to raise here, and that in my humble understanding of things has played and is increasingly playing a huge role in all the intra-European economic discussions, and that's the target 2 reality. What is target 2? It's the kind of internal, how should I say, internal system of accounts between the countries. And if you look at these internal accounts, they were, until the financial crisis of 2008, they were basically zero. They moved a little bit. Today, we have a situation, I didn't check recently, but a month ago, we have Germany has a credit on the euro system of 1,200 billion euros. The euro system has a debt towards Germany of 1,200 billion euros. Spain and Italy have a debt towards the euro system, which basically is a debt towards Germany of each 600 billion, rounded numbers. You see the picture? As long as the euro exists, that's not an issue. By the way, the same system exists in the United States, but each year, and it's not a joke, on April the 1st, these intra-state debts or credits have to be adjusted. They have to be put at zero. And there are all kinds of mechanisms to help the states do that, but there is each year an adjustment towards zero, whereas in the euro area that doesn't exist. And of course, this was not created because everybody realized if you created something like that, you would enormously impoverish the southern European countries and enrich the northern European countries in the beginning, although after the same time it reverses. So I've been witness to discussions where I thought to myself, my God, how is it possible that Germany moves from position A to B to C to D to E to F to give in on what from the southern part of the euro area was asked. And I've come after many nights of thinking and days of thinking that it's the target too. Because if the euro explodes, Germany has a loss of maybe not the 1,200 billion, but certainly 800 or 900 billion euros. Because immediately, if the euro explodes, you will have again lira or pesetas or whatever, and they will devalue by enormous amounts vis-a-vis the new German mark or whatever they call this currency. So that's a risk Germany is not prepared to take. My question to them, and I'm not going to name names, but I've asked certain persons in German governments what they think about this, and the reaction was, shh, don't talk about it. That's the more than the elephant. That's a dozen of elephants in the euro area. Is the target 2 account situation, and a lot of the NGEU money that we see floating around now will have as an effect that the situations of Spain and Italy improve a little bit. Not much, but they will improve a little bit. And the situation of Germany will worsen a little bit. But if nothing else happens, then the whole charade will go on. Within 2 or 3 years, the curves will reverse and we will see a further increase of the debt that the euro area has vis-a-vis Germany, basically Italy and Spain, on the one hand, and the debt of Italy and Spain vis-a-vis the euro system, vis-a-vis the Germans, although Holland is also quite important. Sorry? Yes, you're right. But there are more Germans, as you know. Yes. So you're welcome in Belgium. Because we're basically at the zero line. We're
Okay, moral of the story: live in Southern Europe, including Belgium, and stay close to central bankers. So then I'd like to open the floor now. So if you want to ask a question, first introduce yourself and please keep your intervention to 2 or 3 minutes. So first, and then gentlemen.
From Bolivar. Well, I mean, this is not about monetary policy at all. I mean, something that, okay, I will give you a very abstract kind of answer to this because it's not about monetary policy, right? But something that I genuinely admire about Bolivar is that he was a person with the courage and with the vision to pursue something different. I do believe that my generation, I'm 26 years old, sometimes we are too stagnant. Sometimes we don't have a vision for the future. You know, I was reading the other day an historian called Timothy Snyder, and he said that something that is very different from our generation in this moment of time is that we don't have a vision of the future. It's not like the 1990s, not even before like that. And I think this is something that we need to build. And we need to build what kind of society we want and with optimism. Because when I hear my friends talk about society falling apart or the economy falling apart or the political institutions not representing them, what I tell them is that, yeah, that might be right. But at the same time, we do then need to then create our own institutions, our own ideas. So if you ask me something that I admire from Bolivar, beyond creating the independence of 5 nations, is also the courage to think in a bold way about what kind of future we want. And this is why, beyond the issue of inflation, all of us discuss about ways to create economic growth and development and inclusive development. And that's why I really believe that the great transformation of our economy is not really about subsidizing the people's consumption in the short term. I do not believe it. I believe that all our resources, all our infrastructure, all of great minds, all the great economies, we need to be thinking about ways that we can have a better economy with better jobs, with more inclusive institutions and infrastructure. So yeah, that will be my very abstract kind of answer to your question. Thank you.
All right, thanks. Yes, gentleman in the back.
Good evening, citizens. My name is Angelos Harlaftis, Epafos Advisors. We represent the EcoWaves movement, a pan-European and Mediterranean regional movement which is based in direct democracy in science and in ecology. We thank the Honorable Minister and MEP and the lady from the Deputy President of the Austrian Bank and the other colleagues for their presentation, especially Max, which the citizens on the ground, they know for the last 10 years what's going on. The problem is that we have a big problem here in Europe because our opponents, the communists or the national communists, like it's Putin, which are trying to build a new regime, they know our disability and dysfunctional of the system, because a student from the first year of the university knows that when you are cutting money from nothing, you are going to create inflation. So I think that the scientists and the administrative persons which are guiding European affairs the last 100 years, they have a responsibility on the Bretton Woods agreement, which put out the valuable metals and the gold to enter to another system which is dependent from the US, which worked for some years, for almost a century, well for our development, but growth is not the main thing in the nature. Nature has three elements: has growth, has conservation, and has degrowth. We cannot grow always. We're becoming also older. So these economic systems which are governing our societies for the last 200 years, I'm speaking also for the communistic, socialistic ideas, they don't have a natural consequence following because they follow only the growth thing. So the problem is, what are we going to do, we, the Europeans, because the debt now is not 300 billion and 1 billion or something, the Germans, is nothing. Now the Americans, they were discussing for more than 35 billion debt, which means we cannot create an economy with debts. Before the banks, they were lending, when they began in 70s their system, they lended €1, $1 real for 10 credit euros. Today, we don't know how much is this. So we are in a difficult position, and we as Europeans, we have to take our own, the things on our own fortune and not on behalf of our allies, who they are controlling the system and their amount of money cannot be measured. That means a lot. The inflation will create a crash. Thank you very much.
I would like to make a short reply because um, the word growth is often mentioned. And actually, last week or the week before, I'm looking at my collaborator there, we had here in the European Parliament a colloquium on degrowth, no more growth. Are you serious? Are you really serious? Do you want that? That's creating a civil war. I assure you, an economy without growth can only redistribute. That's the only game in town. So you can only take from you to give to her, or from him to give to her. That's the only thing you can do. So a society without economic growth is a society that after, in less than a decade, will have a civil war. If you want that, okay, but be conscious of the. So you need growth. The question is which growth? And for example, there is a nice graph that my collaborator put together where he puts out economic growth in Germany, CO2 output in Germany, and other environmental indicators. Growth goes like this, and the other indicators go like that. So a link between growth and exhaustion of resources and ecological damage is nonsense. It depends on the policies that are installed by governments and that are at the origin of growth. And there, of course, major mistakes have been made, also by me and the government I was in, and by all the other governments. But in principle, there is no contradiction whatsoever between economic growth on the one hand and ecological quality on the other hand. It depends on policies. And that's something that I have the impression that's very slowly sinking in, because like you said very correctly, the startup of inflation, I try to personify things always. That's Mr. Timmermans. He ignited the inflation with his Green Deal and the total lack of attention for the transition period between the situation now and what we will have as a situation if we are totally dependent on sustainable energy. That's the basic, the starting point of this inflation is that. And the monetary overhang created the environment to let inflation develop, blah, blah, blah. But it started there. And so we have to fundamentally readjust our policies to have a better environment, to limit climate change, and to have economic growth. Because you can't have a livable, enjoyable, solidarity-driven society without any economic growth. That's just a contradiction in terms. It doesn't exist.
Is it empty or full?
All right.
Sorry, I'm a little
I think we
Laura?
have to be very excited about it, because if we do not allow creativity to kick in, we will not be productive, and then we will not grow. And we need growth for all our well-being, because we rise the tide for everybody, and not we don't want to be all poor and stupid and equally not mobile or whatever.
And we think we are poor, but we are not. And we do not cherish what we created as a democratic platform, which is solid, which we have to take care of, to remain it, to get to take. We have to take care of it to remain solid. Voilà, that's it.
So I think an issue related to this is also that very term growth, whereas in some respects I prefer maybe a word like prosperity. Growth connotes this idea that you just have more stuff is produced. So that's what gets some environmentalists going, because they would argue that's what digs into the environment, that's what causes environmental problems. Actually, if we use the term prosperity for a moment, again, that graph is excellent, Johan, that you mentioned, where prosperity goes up and carbon emissions go down, but also more prosperous countries tend to care far more about the environment than poorer countries, because if you can barely afford to feed your children, you obviously have far more important things to think about. Whereas Switzerland or somewhere with an $80,000 or $90,000 per year GDP per capita, they can afford to care a lot about the environment. But additionally, then, if we look at what happens with prosperity in terms of technology, think about this. Think about what this does. In previous generations, there was actually a photo that I saw where on one side it had this desk with all of this stuff. It's got the calendar, it's got a camera, a microphone, all of these different things. And on the other side, it's just got this. And that's the result of prosperity. So no, I think it's the exact opposite from what these people are saying. What we need is more prosperity. And what prosperity will bring about, among other things, is a cleaner environment, actually.
Thank you. Yes, exactly. We need to be passionate about this because we want people to have good education. We need growth. We want people to have a good pensions, good houses, a good standard of living. We need growth. We want to have democracy. We need to have economic prosperity. There is no other way. Why do we have these volatile systems in places like Latin America? It's because we have half of our population without any kind of economic inclusion. And we have not found ways to have economic systems that include them in our system. And these people then don't feel represented, and with reason. These people then see that they don't have enough money to retire, they don't have enough money for the education of their children, they don't have enough money for their houses, for feeding their families. So this kind of idea that we need to degrow, I believe, is the kind of idea that I see when I come to very rich countries. But when I'm in Latin America, or when I'm in African countries, or in developing countries, what people, the normal people, the people that I see in the supermarket, on the streets, what they tell me is, Jorge, how can we find ways to have economic growth, good jobs, prosperity? So I do believe that this notion that I see is extremely, extremely harmful for society, because without growth, there is no prosperity, there is no development. We do need to translate that growth into public services, into public goods, into integral kind of development. But to do that, we need economic growth.
All right, thank you. We have about 10 more minutes, so please, there was somebody else, and maybe, yes.
I would love to do that, but not here. Okay, so I'm an undergraduate student at KU Leuven, as well as an intern at the ASEAN Chamber of Commerce to the European Union. I'd like to first of all say thank you for providing us a platform to talk about an issue that affects everyone in this room as well as the world, namely about central banks as well as inflation. I think everybody in this room also shared the same concern about inflation in Europe or in other parts of the world, and the fact that central banks have not done enough to tackle this issue. And as Jorge previously said quite rightly, that there's a categorical difference between Venezuelan political institutions and the European political institutions, and that the kleptocratic rule of the Venezuelan government was the cause of the economic catastrophe that is happening in Venezuela. Do you think the failure of the central banks or the governments of the European Union in tackling this issue is an indication of a democratic recession?
Again, what was the last sentence? Because can you please repeat that? Democratic recession or decline? Well, as I mentioned before, if you mix monetary policy and intervene constantly via, say, Brussels, name it as it is, then you end up with the consequences that we have seen. And the question is, that's not a question of democracy. That's a question of respect and of how you deal within institutions. And if you stick to your own rules and regulations, and that is something that has not happened over the past couple of years, and where our own laws were being broken. And that is maybe undemocratic, if you want to put it this way. It's clearly risky, and it creates problems, and the problem is on the plate. And if you don't look into models, and if you don't use the systems of the old century and think that this will fix the current issues and problems, this simply does not work. I mean, we have always said MMT is neither modern nor monetary nor theory. It simply does not work. And what we see these days, it's proven, it's a fact. So what at the ECB is currently being done is, and there are great economists in place, they are looking at new models, they are looking to redimension things and ask other questions, not the same that we did last century. They really are looking into things from a different perspective and angle. However, if politics intervene, it's an issue, and that is what we have seen.
Yeah, I want to add really quick that if I can say something, is that every institution has to have its own mandate and objective. And in the case of the European institutions, there is something that we clearly see that is very worrisome, which is the politicization of some institutions. Coming back to the next generation EU funds, is that in order to give these funds, there should be some kind of criteria. And in fact, initially there was this criteria. They were going to give some specific grades to every country on specific parameters. And what they did is that they give the maximum grade in all aspects to all countries. What does this mean? Is that there was not really any kind of real assessment, but it was really a political kind of decision to just give out the funds without any kind of criteria. Those are the kind of things that you don't see in developed countries, because that's not the way that you do institution design. So yes.
Maybe to correct you a little bit, what happened with the NG, or what is happening with the NGU funds, is that there is some conditionality. And we can discuss whether it's taken seriously enough or not. There are legitimate questions about, but there is certainly, and there is a lot of pushback from the Commission vis-à-vis certain countries on certain issues. We all read about, what was it, the football stadiums in Italy that were to be renovated with European money. And there are a lot of other things that don't get into the newspaper, where indeed the Commission pushes back on these countries, saying, no, this is out of the question. For me, the weak point in the whole NGU construction is the control afterwards. Who controls what finally happened with the money? And the gigantic wisdom of the European Council of Head of Governments was that the countries should do that themselves. And you probably remember that your prime minister held the European summit hostage for 5 days even. On that was on this issue. On that specific point, they were kept here in hotels and other places. But it's still, we have now a kind of alarm procedure where if one country thinks that another country is wasting money, they can pull the trigger, so to say. But do you see anybody doing that in the present circumstances, that, for example, Holland would say, no, stop it, because Portugal or Italy or Denmark, whoever, is wasting money? That won't happen. So that's the weak point. There is no really ultimate stringent control on the use of money. But on the projects, there is a fair amount, or in my opinion, an acceptable amount of scrutiny at the source. Could it be done better? Yes, but
I think we should also go back to first principles, European values, competition, achievement principle, but especially competition, and to allow that also among each other, not only individuals but also on the national level, and look at that for to look for the business and labor locations in a very competitive way. Look at from this side, and this would probably trigger something within Europe, that we do not find the least common denominator, but we rather aim higher, and that would be an ultimate goal for us to go back on track and be back on the international scene.
Very good. Yes, maybe one more intervention.
Thank you. Hello, my name is Christian Ballot. I'm just a resident of Brussels. If I got that right, we talked about that low interest rates also provide for a lot of easy money for governments. So my question is a little bit like, what's a chance actually that you see that there would be kind of a voluntary reduction in public spendings in Europe, given that we understand how organizations work, how many people are involved in consuming and redistributing that money according to their ideological preferences, and what would be the scenario, or what could be the scenario, is if there were not such a voluntary reduction in public spendings. Thank you.
If we don't reduce that, we will hit the wall eventually, even faster than we are on the track now.
We shouldn't be too pessimistic. Look, for example, at Ireland. That's not a chimpanzee economy. They had a huge debt after the financial crisis, with the huge banking crisis they had. Look at Ireland now. They didn't default. They got a little bit of help from the EU, but not very much. And their problems with respect to debt are gone. Why? Because they took care of having a budget in equilibrium, no more deficit. That should be possible. And growth, economic growth. If let me say the following: if any European country, Italy, Belgium, even Greece, has 3 years of budget equilibrium, no deficit, and 3% real growth, nobody talks anymore about debt problems. 3 years of budgets in equilibrium, no deficits, and 3% real growth rate, and the issue is gone. The debt is not gone, but the issue is gone. Yeah, but the European Union are 27 member states, so if each takes care of this on its own, and I think this is the moment to do it, because this NGEU money, that's 735 billion euros, is flowing into the economy now. In terms of economic proportions, this is the moment for countries like Italy and Belgium to act and to reduce their deficit.
All right, good.
What happens if they don't do it? I don't know. Then they will hit. Yeah, but it's in safe hands, so you don't have to fear them.
Let's hope so.
I know everything about that.
Okay, good. Max or Jorge want to? No. Okay, well then I think we can maybe conclude here. So I would like to thank the whole panel for their contribution. So thank you. And of course, thank you for making it here, and we look forward to see you at one of the next debates. Thank you.